Happy New Year, everyone, and welcome to the first episode of 2024. We hope that your year is off to a fantastic start, filled with opportunities and aspirations. To kick off this promising year, we've a special treat for you. Joining us once again is the ever insightful Christian Babcock from the Loan Depot. He's bringing us a wealth of expertise in the world of mortgage and financing. So today's episode, we're diving into new loans and possibilities. So without further ado, I'm going to introduce my co-host. Hey, Christian.
Hey, Steve. How are you doing?
I'm doing good. How are you?
Good. Thanks for playing. Happy New Year.
Same to you, my friend. Same to you.
Yeah.
2024. Can you believe it?
I can. A couple extra gray hairs, a couple missing on the top, but yeah, definitely.
Not as much as me, buddy. Not as much as me.
That's looking good. Man. Looking good.
So how was the holidays?
Good. Spent a lot of time with the family. It's usually a good downturn, new business that for the week between Christmas and New Year. So it's a good time to, relax and, enjoy the family, enjoy the holidays, and, get ready for the new year.
That 1 week in between, Christmas and New Year's is always like everybody's just on slow mo.
Oh yeah. But again, in a seasonal business, we got to pick our spots. It gets, you know, when it gets busy, when it gets slow. So I usually vacation, around that for sure.
Yeah, when I first started in the business, I wasn't even thinking this far ahead, right? Like I always kind of knew that I was going to be in the business for the long haul, but like I didn't really think like, all right, what is the market going to be like 20 years from now? What kind of challenges are we going to face? What type of clients are going to be out there? What type of market are we really going to be in? And what are my actions going to do to try to make sure that I'm on top of the market and make sure that I'm serving people in a way that is actually bringing value?
Yeah. So forecast 20 years out in this business, in this industry you can't even forecast 2 years out. Nobody expected COVID, nobody expected, we've been through in my 20 plus years in this business. I've seen every cycle. We continuously have to adapt. We've had down cycles, we have up cycles. We've had buyers markets, sellers markets, we've had recessions, we've had pandemics, and the industry, especially the mortgage industry, is constantly moving and changing, and we continuously have to adapt to that. It's not static for sure.
Yeah. And our businesses are so connected, right? The mortgage business and the real estate business, that it's so important. And I'm so glad that we started doing this because, like I told you on the phone earlier, that I'm just learning so much more now that we're just having these conversations. Because a lot of times, we're having the conversation on the phone, but it's okay. So that's kind of like for my ears only. But now this allows us a platform to share it with people that are actually listening to conversations between us. And on a professional level, like it's not just like, oh yeah, rates are down, go do this, but like we're able to explain why they're down and what they should do to kind of prepare for the upcoming cycle. Right.
And I hope it's helping people realize that, there is so much more to transacting in real estate, especially getting mortgages, and, working with the right people is important, but it's also, there's a lot of fear out there amongst buyers. There's a lot of myths out there. I hear them every single day. I hear people, especially first-time home buyers, they're all over the internet. They come to me with questions that I know exactly where they got them. And most of them, a lot of them are myths. Some of them are half true. Some of them are 100% right, but it's rare that, so like some of the things that people come to me that they've read online are 100% accurate, so we're kind of, from just a few years ago, educating people right out of the box. Now you're kind of like we're not only educating people, but we're also like pushing back a lot of myths and just mistruths, especially when it comes to things like credit. So much, that's multiple episodes of this we could be talking about credit, and a lot of the confusion that and probably the need for regulation when it comes to credit scoring and things like that. That's really the toughest one.
Yeah, that could be a couple episodes in itself.
Absolutely.
The fact that we are literally we spend our whole lives, learning about credit, and then at the end of the day, we're literally just three numbers on a piece of paper.
Mm-hmm.
And that information is what is being used to basically decide whether or not we're going to pay our mortgage every single month, or get a loan, or be able to change our family's lives. It's insane.
Well, and the challenge is more and more and more. Every facet of your life is being like determined by credit.
Yeah.
Whether it's something as simple as a car loan, but even when you go on job interviews, employers run credit reports. Your insurance agencies run credit reports, and they're all running different credit reports. And because there's no real unified system, there's just a lot of confusion out there when it comes to credit reporting. But yeah, we could definitely set that up. I could even get some credit repair specialists on here with us. That would probably be very useful for people to hear a lot of those things, because I always say, like, your team meetings and stuff like that when we're talking with the real estate agents, but I know a lot of good credit repair people that are out there also trying to really dispel some of those myths.
Yeah, you referred me to a credit repair person about 2 years ago, and I hired them for my own personal use, and it has helped tremendously, just simply from like the task of getting like some of those, like, you're in college, they're giving credit cards to everybody, and like you have stuff that's just sitting there, a 30-day late notice from however many years ago, and they're just knocking those things off, and the score just starts climbing and climbing and climbing.
Yeah, I just had a guy recently that he had like a $20 missed payment. I think it was on an Apple card, and it had something to do with he had taken a trip and they didn't take American Express, and he was overseas. So he got an Apple card because you can get it right from his phone. And he did it like just to be on that trip, and he never used it again. They then charged him a $20 annual fee that he missed, and it brought his credit score down like 60 points, and it was for $20, So it's stuff like that is really, and I run credit for people all the time, and they, when I'm showing them things that are on the report from 6-7 years ago that just aren't on a lot of the other reports that only go back 2 or 3 years. So that's where the confusion comes in, because they're seeing a higher score than what I'm seeing, and then I have to explain to them how the entire system works.
Not to get off on too much of a tangent, but like just the fact that like we'll see, like, because all the credit card companies, what they're doing is they're giving you like, oh, get your credit score for free, and we'll show you your credit. So they're looking at one number, and then when you go and you run it through underwriting or do what you have to do, a totally different number pops up.
Right. So, and that's what causes most of the confusion, because it's also under, the same, bureau. It'll say Equifax, it'll say Experian, we're running this through the same bureau. So it's, but yeah, let's not go too far on this. I know we had an agenda we wanted to talk about.
Yes. But that's kind of what happens when we get started talking, right? Like you just start getting into these minutiae, right? All right. So I'd like to just start off kind of with, is there any recent news or anything that we should know about that's happened in the past couple of weeks since we've spoken last?
Yeah. So, one of the ththings, I think we had mentioned it on a couple of different calls, because it was announced back in like October, November. Every year, FHFA, which stands for the Federal Housing Finance Agency, it's a government agency that oversees Fannie Mae and Freddie Mac, which are the two government-sponsored entities that put out mortgage guidelines for conforming mortgages. It's a lot of jargon there, but basically, every year they put out their new loan limits, which essentially means the loans that they will back through these agencies, right? So, and because the market depreciates, every year that tends to go up, because home prices go up, and there's a need for larger mortgages, to be covered by these agencies. So I think when I started in the business, I'd have to remember, it was 417 for a long time, and I want to say it was even lower than that when I started in 2002. I'd have to look.
So hold on, let me just make sure we're catching up here. So we're talking about the limitations that they're going to put on you being able to get a mortgage. So for example, and when you first started, if you wanted to get a mortgage of $500,000, you wouldn't be able to do so because the limits were only at 415 or 417.
That's that. Let's say, exactly. Let's start from the beginning. It's a good distinction, because, right. So these are, mortgages. That's how you couldn't get a mortgage from over these limits. It's that it becomes a different type of mortgage. Becomes, rather than a conforming loan backed by these agencies, it would become a jumbo mortgage. So a jumbo mortgage is essentially any loan that's over these limits. Jumbo mortgages historically have tougher guidelines, bigger down payment requirements. For example, historically 20% down minimum, 700, or higher credit scores, reserves, meaning after you pay your down payment and your closing costs, they want to see, 6, 12, sometimes 18 months in reserves, what like left in the bank, which could be retirement accounts and things like that. So jumbo mortgage guidelines are more stringent because they're bigger loans, they're riskier loans for banks to make. And typically the banks are holding those loans in their portfolios. They're not being sold off to these agencies. So,
gotcha. Okay.
So that's why these agencies are in place to open up home ownership to people that don't meet that criteria, that don't have the 20% down, don't have $1 million in the bank, that may only have the minimum down payment. And down payment is really the important distinction, because the loans that we're going to be talking about today allow for, as little as 3.5% or 5% down on a single family home. And now very recently, Fannie and Freddie opened up multifamily homes to do as little as 5% down, where traditionally they wanted 15 or 20% down for 2 and 3 and 4 family homes.
Wow.
So the bottom line there is, you can get into much larger loans with still low down payments, which opens it up for more people to be able to buy.
Now, I imagine that this is, as you stated earlier, a reflection of the increase in the average home in certain markets, right? Like, so like, 20 years ago, you were able to get a single family home for, $450. Now they're creeping more into like the 600-700s because of all of these other factors, right? Like you got the interest rates up, down, and then you've got so many different, inflation, all these different factors are being weighed into now, deciding the limits that these organizations will back certain loans.
Right. So you and I, we're always focused on, the areas in and outside of, New York City. So New York City, the boroughs, the surrounding counties outside of New York City, so northern New Jersey, Long Island, Westchester, even up to Putnam, are considered high cost areas, right? So the agencies, so Fannie Mae and Freddie Mac, which are the conforming loan, agencies, now they'll cover across the country. They'll cover on a single family home a loan up to $766,500, so $766,500, with as little as 3% down on those loans.
Now, I just want to make a distinction. I want to make sure I'm following you. So the mortgage amount you said was $760 approximately, right?
$6,550 to be exact.
And so that's the mortgage amount, meaning if they put down whatever 3%, the house could cost a little bit more. The mortgage amount that they're going to loan on is that amount.
The loan amount. Right.
Okay.
That's the loan amount, correct, not the purchase price. So now in high cost areas, which again encompass pretty much every suburb right outside of New York City, but parts of California, Hawaii, on a single family home, the agencies will back a loan up to $1,149,825. So let's call it, like 1,150 basically, which puts you pretty much to a $1.2 million single family home with 5% down. Right. So again, and a lot of people don't know that, a lot of people think, especially in those price ranges, historically, you would need 20% down, and, that's, so it's, a limit, it limits people from even starting the conversation, and in terms of whether or not they know they could even buy a home or get a loan that size. Now, obviously they have to qualify for that loan, including the taxes and insurance and everything else. But it does open it up for limited down payments up to those. Now, in each level, when it comes to multifamily houses, those levels go up. So depending on the type of, how many units there are in the house, 2 families, 3s and 4s, which we do a lot of around here. On a 2-family, that high cost limit goes up to 1.472. On a 3-family, it goes to 1.
Okay.
Right. On a 3-family, it goes to 1,779. So call it 1,780. And on a 4-family, it goes up to 2.2 million, 2.211. Right.
Now, I think you had said earlier that this has to be, you have to live there, primary residence, right? So
all for primary residence, correct. All for primary residence.
So if I'm buying a 4-family house where I'm going to live there in one of the units, and I rented out the other 3 units, I can qualify in a high cost area for a mortgage of up to 2.2
million. Right. Yeah. So, again, to qualify.
So home costs four family costs call it 2.3 million. I could put down 3% or 5% on
For
that.
FHA loans, you can still do 3.5% down on that. And then historically, literally, when I say historically, up to just a few months ago, on a conventional or conforming loan, you had to put down 20%, even if you were occupying. Now they just changed it to 5, for conventional loans also. And that was always the big kind of, difference between multifamily financing when it came to, to the two agencies, because FHA would always allow just 3.5% down across the board. The conventional loans didn't, so pretty much anyone with a limited down payment buying a multifamily was using FHA. There were some other conventional loans that allowed, if we had lower income and things like that, we can get into, but for the most part, our standard conventional loan, conforming loan, 1 to 15% down on a 2-family and 20% down on a 3 and 4.
Yeah.
So that is a big change, and the reason that it's significant is because if somebody has a high credit score, the conventional loans will be less expensive. There's differences in the PMI. PMI would be less expensive. It drops off. Things like that, which are like specific nuances to each loan that could make a conventional loan just better for a home buyer than FHA. It's just good that both doors are open.
I'm literally thinking of one client in particular that has been looking for something like a 3 or 4 family in those higher price points that this might actually work for. So deal breakdown, right? Like on the fly. So we're looking at a 4-family house. Let's say the price is 2. You have your healthy calculator. I'm sure you do, right?
I do.
Let's say 2.2 million, right? Purchase price.
Mm-hmm.
You've got 4 units, right? $2,500 each unit, right? Taxes. Let's call taxes $15,000.
Mm-hmm.
Is that enough information for us to kind of figure out if this is a good deal? Yeah, it should be, right?
I don't know what you're trying to figure out, but I'll go for it. Let's see. So
2.2 million.
Mm-hmm.
And I've got, let's just say I've got 5% down. So 10% would be 200, call it 110,000.
Mm-hmm.
All right. So my mortgage is going to be approximately a little under 2.1. So call it 2.090. And I've got 750 credit.
Mm-hmm. Mm-hmm.
So the first thing I would do is I'd look at what my my monthly payment would be on 2.090, right?
Mm-hmm.
What does that number look like?
The mortgage by itself would be between $13,000 and $14,000 a month.
$13K a month. All right. And then you've got I could see right here, just based off that income, it's not necessarily going to cover itself, right?
Right. Yeah, and it's not, especially something like, you're thinking, I know you're always thinking from the point of an investor, so, and again, for a primary residence, you're not with 5% down, you're not going to see a return, but but what you were saying, for somebody who's going to be living there, and they want to be in a certain, specific area, and, it's going to appreciate over time, but it's a place where they're actually going to live. That rental income just helps them make that payment. So, so if you have 3 other tenants, that are paying you to, $2,500 a piece, that's another $7,500 coming in additional income that's helping you, or have other people helping you pay your mortgage.
Yes. Okay.
And that's always been the appeal with multifamily housing, even as simple as a 2-family. I have a lot of people that come to me like they are specifically looking for a 2-family house, even if it's a basement apartment, paying, $1,500, $1,600 a month, just to help them live in a place, in an area that they want to live in, and help that, and that tenant is really helping them pay their mortgage. So it's definitely not for this math is not for an investor who's looking for like, all right, I'm going to put in X amount of dollars and see a return.
It's somebody who's making a couple $100,000 a year, and they're like, you know what, I'm going to live in this neighborhood, and I'm going to this is going to pay half my mortgage.
Right. And you'll be able to live there, and you'll have tenants, and then, eventually over time, maybe you move out in a few years, and then you're renting all of the units, and then you go buy a single family house, and then, now you have higher rents, and you're renting all 4, and that's offsetting it. And refinance the mortgage down the road when there's more equity and lower the payment. It's a great way, especially on multifamily housing, for people to get into a place where they can live and then eventually maybe convert that into an investment property, a full investment property.
And listen, in these areas that we're working in, these things are going to increase in value, based on the cycle. So, maybe it'll be worth more, in 5-10 years from now. And then all of a sudden now it's worth 2.5, 2.6. And then you could turn around and maybe get creative with some sort of line of credit or something to that.
Oh, yeah. Yeah. I mean, I could tell you stories for days on people that have bought in areas that, just 5-6 years ago, or even in some cases less, that have already doubled, their investment. I've had people that have, I've looked at some of them and at the time when I've seen some of these people buying these properties, I'm like, oh, that's feels like a lot, and then sure enough, 4 or 5 years later, I'm like, oh my God, that guy had it, got it nailed, so it's,
I love those calls from the clients who are like, listen, I just sold them a house like 2 years ago. Listen, my neighbor's house sold for X amount of dollars. Like, check the value on my house because I want to see if I can tap into that.
Yeah, I had a woman that bought, I did a 2-family in the Bronx with 3.5% down FHA. And I think it was like within 2 years, maybe 2.5 tops. The value had appreciated so much that we were able to refinance her out of FHA into a conventional loan, which means her equity was up 20%, in that short amount of time. And it was like a $600-700 difference lower in payment, dropped the PMI, dropped the, and it was, it's a huge win, But again, we can't speculate that for home prices are continuing to go up.
At some point, you got to think at some point, like they got to stop, but
affordability stops it. Eventually, I think somebody, don't quote me on this one, I know we're being recorded, but I heard a statistic yesterday. That was saying that I think on the East Coast, even only 30% of people are actually qualifying for mortgages in this area. But that 30% of people is still a lot of people, so, home prices are still, they're expected to go up this year, another 7% on average nationally, just based on supply and demand, so, but there are still enough people that can afford them. But eventually, even the people that can afford them are just not going to want to pay as much, and it's got to equalize at some point. We just don't know when. So, but affordability is it. I mean, there's a calculation, it's an affordability index where you can actually calculate based on the median income in a certain area where that kind of limit is based on the median income in a specific area, the affordability index. And we're just, we're just not there, and again, it's more so because of the limited inventory.
I have a client who owns a commercial property, and he was telling me that he has a tenant that their lease increases are based off the affordability index. And I've heard the affordability index before, but I didn't realize that in the commercial world, like that's something that they do. Like they're tying the increases into that, and the tenants are doing that because they want to make sure they're not getting priced out on their increases, especially for like these. His tenant is a hospital, and it was like a 20-year lease, and they're like, listen, the only way that I was able to get them in was by tying it to the affordability, because they were afraid that it was going to, just say standard 3%, 3%, 3%, 3%. But then at some point it becomes unaffordable. And them, obviously a hospital, they have a lot of very intelligent lawyers as well that are negotiating these leases for them to make sure that they could stay in the properties.
Right. But that's the situation we're in now, because inflation has been growing at a pace much faster than wage growth. And wage growth has been almost stagnant for many years. People's wages and salaries and everything are definitely not keeping in pace with inflation. Historically, they kind of, if you're in inflation 2-3% per year, that's when you start seeing kind of standard salary increases 3% a year, because they're keeping pace with inflation. But when inflation is at 8%, or 7%, employers aren't rushing to raise people's salaries 7-8%, especially when they're expecting inflation to kind of calm down a little bit. You're not going to, be out there and increasing wages to that extent that quickly.
I hate to put you on the spot, but what is like the most recent inflation rate? Do you know what it is? Is it 7-8%?
No, it's down into the threes. It's like 3%.
Okay.
It's so just under, I think it was 3.7%.
Interesting.
So it's definitely calmed down a lot, which is why we're seeing mortgage rates start to kind of cool down as also. But it's been much slower than anticipated. In terms of inflation coming down to the Fed's target, which is 2% year over year. And then I'm definitely not an economist, but and everybody's got a different opinion on the subject in terms of if that's a realistic target, if that's we just have to accept the fact that it's not going to be 2%. We're going into a recession. I mean, it can continue going on. Depending on what channel you listen to, you can hear 10 different opinions.
Depends on which viewpoint, from the left, right, middle, where you're getting it from.
Yeah. So,
all right. So loan limits are up, right? But let me ask you. Let me just kind of segue just a little bit here. What are you seeing with rates right now? Because I'm seeing that they dipped down, right, from the last time we spoke, and then they've kind of are staying stagnant right now. They went up a little bit like the past 2 days, and I kind of based it off the 10-year yield number. But is that accurate? Is that what you're seeing right now with rates?
Yeah, I mean, it took a pretty significant downturn between November and through December, and then really the first couple of days of trading this year so far, we've seen a slight uptick, but the expectation is that they're still going to trend down. It's just a matter of we're gonna it's continuously bumpy. We'll see, we'll get an increase, we'll see a good decrease, then we'll see a little bit of an increase. It's really when you look at a trend line, that's when you can kind of determine which direction they're heading. And a trend line in the last 2 years has been like, up, down, up, down, up, down. It's been crazy, So, but they're hoping that in the first quarter of this year they'll continue trending down, and then possibly the Fed will start cutting on their end in the middle of the year. I know Wall Street a lot of people were betting on a March Fed cut. I never really thought I personally thought that was too soon. But again, it's the same thing. Like, you get different opinions from all over the place. Some economists are thinking not to the end of the year. Some are saying middle of the year. It's it's hard to be right, in this circumstance, and usually none of them are. But so
are you seeing an uptick in applications or people that are applying for mortgages?
Not this time of year. It's a seasonal business, so I'm seeing a lot of still co-ops going, condos going. The larger priced homes, they're still moving, but not at the same pace as some of the lower co-ops, condos, more affordable housing that we have. And that's also a result of it's just the season. Around the holidays and stuff. And a lot of people that are going to be selling houses will wait for spring. The houses look good. You got better curb appeal, things like that. So, but I have talked to a lot of agents that I work with. One in particular said she's got, I think, 25 listings lining up, for the first quarter.
Nice.
So, which means like they've been gauging interest, and like speaking to their clients and everything else, and they're basically preparing. That's just one agent team. That's so hopefully that's a good sign. That we can start seeing more inventory drop. Yeah, I read one article that was saying like this year will be the year of acceptance, which is, the people that are sitting in the houses with the super low interest rates that want to move but are waiting for rates. This is the year of acceptance that, you're going to probably have to give up that 2 or 3 for, a 5 or 6, if you want to move, so it's the 2s and 3s aren't coming back anytime soon.
Yeah, but you know what? The 5s and 6s, it's easy for me to say it because I'm not in the position, but like the 5 and 6s, it's just, as long as it's affordable and if you have reasons, and we've talked about it before, right? Death, divorce, downsize, debt, like if you have a reason, you have to make the move, like, and for a quality of life, it's not the worst thing in the world, man. Like, it's just, you got to kind of, like you said, just accept the fact that you're not getting that 2 and 3 anymore. That 2 and 3, right. That was, again, I've been in the business just, a little bit, almost as long as you, and I've never seen that before. And we had it during the pandemic, and I think that was just kind of the government's way to keep the market moving in some direction, which, good, bad, indifferent, whatever it is. I'm not here to, pass judgment, but it's not coming back. I don't see it coming back, at least in my opinion.
No. But it was also, there was a number of factors that's caused, especially in this area, the inventory shortage, because, the outer suburbs, the outer areas, and the boroughs outside of New York City, we see, a certain number of people naturally come out of the city. A lot of people live in the city. get married, they're in an apartment, then they want to start a family, they move out to the
Yep.
suburbs. They go out to the Long Island, they go out to Westchester, depending on where they are in the city. They kind of spread outward. So we're used to seeing a certain percentage of people every year just by that natural migration. With COVID, you basically quadrupled that in 1 year.
Oh yeah, everybody was just the
floodgates
opened.
Everybody was moving everywhere, so we basically oversold everything that was available in the outer counties, and there's only so many houses in this area. Like, they're not building subdivisions, they're not building high rises to keep pace with the people coming out. So now you got people that are in the either they might have rented a place and they're staying in that house now, and they might even be buying that house now from the owner privately, and you don't even see it on the market. You have other people that bought, in the suburbs that might be moving back to the city, but now because they have a 2.5% rate on that house, are keeping that as an investment property and not selling it. They might be keeping it. So
less inventory. That just leads to less inventory.
Right. So we really just oversold, everything that was, and again, there's still movement, it's not, not to discourage people. There's still, challenges in getting offers accepted because of limited inventory, but that's also where you want to be working with the right real estate agents at this point. The more experienced agents that know how to negotiate a deal, know how to put a deal together. You're going to win.
Yep. All right. So I think I covered all my questions I have. Is there anything that you'd like to add before we log off?
No, I think we're good. We're at our time slot.
Yeah. All right. So all right, everybody. So that's a wrap for today's episode. We hope you found our discussion for new loan limits and possibilities both informative and inspiring. Thanks for joining us as we explore the evolving world of real estate financing. Special thank you to our incredible guest, Christian Babcock from the Loan Depot, for sharing his insights and expertise. So everybody have a good week, and we will see you guys next week. Take care.
Thanks, Steve.
All right. Take care, Christian.